Welcome back to the channel. Today in part 4 of our value investing series, I'm showing you how to actually find Graham style stocks using free tools and when to buy and sell them smartly. Also, stick around till the end for a sneak peek on our next mini series we're putting out. Welcome back to StonkCast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play, or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host as always, Brandon Shar. Happy Memorial Day weekend, everybody. And we are finally here. It is part 4 of the value investing series based upon Benjamin Graham's book, The Intelligent Investor. Part 1, we briefly walked through a history of who Benjamin Graham is. Part 2, we broke down a little bit of his philosophy. And part 3 last week, we actually laid out what that criteria would look like updated for 2025. So if you haven't seen any of those, make sure to go back and watch them. And today, we are putting it all together, and I'm going to show you exactly how I find these companies to invest in using free tools. That's right, folks. Finding undervalued stocks isn't luck, it's just math. And here's how to actually do it. So first of all, I want to show you a couple tools that I have been using for free. And there's no sponsorship here or anything like that. I just like them. The fact that they're free also helps, right? So the first one here is going to be Finviz, finviz.com. This is a very, very powerful website. They have a lot of data and different metrics you can look at. I would say this is primarily going to be for somebody who is more involved in investing, although I'm sure there's a twist on this where you could use it for, swing trading, or I wouldn't really say day trading, but for the purposes of this mini series, right? For the purposes of value investing, this is an excellent, excellent website. Feel free to pay for premium if you want. I found it useful without paying for it. As you can see here, there's a ton of features that, you could get on here if you want to pay, right? So this is going to be one site that we use today to find these Benjamin Graham style value investments. Another one is a website called Full Ratio. I love this website for some of the metrics that we're going to be looking at as it relates to Benjamin Graham's criteria. This gives me a snapshot for free of these different companies that we will be looking at. And also today, I will be including in the description below a copy to this Google sheet that I put together for Benjamin Graham value style finds, right, in the stock market. And on the main page here, I list as enterprising. If you recall from the last episode, that's what we're focusing on here. Defensive is going to be a bit more conservative. We're looking for something more on the enterprising side of things, as Benjamin Graham would call it. So when it comes to value investing, the criteria here, the threshold, we covered all this last week. And then I broke it down per sector in the spiders, right? In the S&P 500. So we have communications, we have discretionary, and you can already see some of the stocks that I found on here, and I'm going to show you how I did that. Energy, financials, right? There's all of them are here, and they all have their different criteria up at the top here, from PE ratios to debt to equity, the Graham number, right? The conservative estimate of what the company should be trading at, intrinsic value, and then also whether or not it meets all the criteria. So I am no Google Sheets expert, but I love this, and it really didn't take a lot of time to put together. Actually, that's a lie. It did take some time, but I will share this for free. So feel free to utilize this if you plan on looking for these stocks yourself. So let's just jump right in. Basically, the whole purpose of today, I just want to show a couple examples, and then I will also show you how I'm testing this out right now with real live market data, right? So let's start over here on finviz.com. I'm going to go to Screener, and under Screener, I basically have right here, Enterprising Investor. This is going to be how I set up Finbox to just get an initial overview of some companies I need to be looking at. This isn't going to give me all the answers. That's why we're using full ratio. We're going to need to do a little bit of math. And between those three items, we're going to be able to find some really, really promising prospects for long-term investing. So first of all, revenue greater than 400 million. The reason I did that and not 800 million is because I want to account for the sector that, technically Benjamin Graham would allow revenue to be a little bit less, which, if I'm not mistaken, was actually real estate. No, that was 800 million. But if you look at one of these sectors, here it is, financials, right? The revenue has to be greater than 400 million. So I don't want to scan and miss any that would fall into the financial sector. So because of that, greater than 400 million, current ratio greater than or equal to 1.5, a PE ratio between 0.1 and 20, price to book less than 2, and a dividend yield greater than 0%. That way we can make sure we're getting everything there. And then as far as assets that match for multiple up here, I did company and I did REITs. Sector I left alone. United States, of course. And then over here, I just selected all 4 of these. So NYSE ARCA, New York Stock Exchange, NASDAQ Global Select, and NASDAQ Capital Market. So those are the 4 I have selected, right? And then primary trading item, I have that selected as well. And so when we do all that, out of the vast sum of various, equities and things that you can invest in or trade that Finbox has in their system, that leaves us over here with 0.1% of the total universe. So 145 out of 163,958. So it really narrows it down. But even from there, it's still a pretty big list to go through, and it can take some time. It's definitely taken me some time, but the stuff that I have been able to find, the companies I've been able to find from doing this is really incredible. So we're going to take a look here at just a couple. I just want to give you an idea of what this process looks like so you can do it yourself, right? So again, finbox.com. We're going to start with the first one here. We got 145 listed here, and the first one is a name that everyone knows, Alibaba. Now, technically, Alibaba is not in the S&P 500, but for the purposes of organization and finding the right criteria, according to Benjamin Graham, if he were alive today, right, to apply to this particular company, I am going to, stick it into the consumer discretionary field of the S&P and what that criteria looks like, right? So XLY is going to be our consumer discretionary sector here, and this is going to be the criteria we are looking to meet. As you can see, I already have 5 in here that I have found. So I have been able to find quite a few consumer discretionary stocks that would meet Benjamin Graham's enterprising investing criteria, right? So let's start off with how I do this, right? So the great thing about Finbox, you can get a lot of things for free on here, and one of which is going to be the 10-year financials. So basically over here under pre-built financial models, obviously at the top, Alibaba gives you a brief rundown of the company, what it's trading at, 52-week high, 52-week range rather, and then some notes on the company as it relates to fundamentals, right? And I like this too. It'll show you profit, health, cash flow, things like that. So anyways, all I want out of here is going to be historical financials 10-year, right? So we're going to pull that up. Now, the first thing I'm looking at under XLY is the revenue greater than 800 million. Of course it is. And, you can put that number in here if you want. So let's just start off with populating this. So Alibaba, the ticker, like so, it's above 800 million. Total revenue is almost a trillion, 996.3 billion. So I'm just going to put that like this. All right. Positive earnings in greater than or equal to 6 of the last 10 years. That's what we're looking at. So you can look at a couple different things here when it comes to earnings. You can look at basic earnings per share right here. You can also look at diluted earnings per share. I like looking at diluted. It's a more conservative estimate of the company. So what I'm going to do here is just take a look and see if we have positive earnings in at least 6 of the last 10 years. And we definitely have. They have been profitable every single year, actually, in the past 10 years. So I'm going to come over here to my Google Sheet and just simply put yes for that. The next thing we want to look at, earnings growth greater than or equal to 50% over the past 10 years, or a 4% CAGR, which again stands for compound annual growth rate. So you could sit around with a calculator and spend some time doing this, but I have a very simple solution here, just using ChatGPT, our good old friend. Basically, all I'm going to do here is I'm going to find that earnings per share right here. I'm going to highlight the last 10 years. I'm going to copy this. I'm going to come over to our good friend ChatGPT and paste this. And then I'm going to copy the earnings growth from my Google Sheet and then drop that in here to ChatGPT as well. And ChatGPT is so smart, it's going to tell me everything I want to know right out the gate. So if we take a look here as ChatGPT calculates this for us, the conclusion, CAGR is 6.68%. This exceeds the required 4.14%. Therefore, the stock meets Graham's earnings growth criteria, greater than or equal to 50% total growth over 10 years. So this does meet that requirement. So we're going to come back over here to our Google Sheet and just simply put yes. Next thing we want to look at is the PE ratio. Now, for consumer discretionary, if you recall from part 3 of this investor series from last week, we are looking at slightly different PE ratios depending upon the sector we're looking at. For XLY, consumer discretionary, we're looking at PE ratios under 15. So we want to see if Alibaba meets that. And so to figure that out, I'm going to simply come over here to full ratio. And at the top, I'm just simply going to type in the stock symbol, BABA. Hopefully it pops up here. And you know what? I don't know if it will on this one, just simply because it is a foreign stock. Full, so that is a good disclaimer, I guess. So full ratio works really well for US stocks, but it doesn't always have foreign companies in here, but that's not a problem. So basically what we can do here is just, again, use our good friend ChatGPT for this one. We want to see what the PE ratio is for this, if it's under 15. And also there's a lot of different websites that you can use for, finding PE ratio, right? But let's just say, what is the PE ratio of BABA? All right. So as of right now, the PE ratio is approximately 16.2 based on diluted earnings per share of 744. So Alibaba has a 12-month price to earnings ratio approximately 16.2. So that does not meet our requirement here. So we don't even have to go any further with Alibaba. Sorry, Alibaba. Not going to work out according to Benjamin Graham's criteria. All right, so let's move on, and let me just find one where I can actually use full ratio with a US company, right? So let's take a look at the next one here, which I believe was Humana, if I'm not mistaken. Yes. So here we go. Humana, this is in the healthcare sector, right? So that's going to be XLV. Let's come over here to XLV. As you can tell, based off this Google Sheet, I have nothing listed right now for that. So let's see if we can get one on the board. The ticker symbol here is HUM. Annual revenue greater than or equal to 800 million. Yes. Positive earnings in greater than 5 of the last 10 years. We're going to come down here again. Historical financials, 10-year. I'm going to click view, and I'm going to come down here to diluted earnings per share. And it's definitely been positive every single year. So that's good to see. So we're going to put yes, earnings growth greater than or equal to 50% over the past 10 years. Again, we're going to use our friend ChatGPT. Pretty simple here with the earnings per share, diluted earnings per share, right? I'm going to copy the data from the previous 10 years. We're going to copy that, simply drop it into ChatGPT. It doesn't have to be perfect. It's pretty smart. And then we're going to copy this information here from earnings and see what we get. All right, so based off this, it does not meet the CAGR of 1.69. This is below the required. So that doesn't work. So basically this one doesn't work either, right? So if we look at beginning earnings per share, it was only 8.44 versus ending earnings per share of 9.98. So that one doesn't work either, right? So let's see if we can get another one here. All right, let's take a look at Met. So this is a financial company. So let's take a look at that. And if this one doesn't work, then just for the purposes of time, I will show you one of the companies that I have found that actually does meet this criteria, right? So I just want to show you what this process looks like though. So let's go over to financials. All right, and we already have a couple examples here. And at the very least, I'll just show you what this process looked like for that if this one doesn't pan out. But let's take a look at MetLife here. The earnings, revenues, greater, positive earnings in 5 of the last 10 years. Let's go to historical financials here and pull that up. And if we take a look here, diluted earnings per share, and this one looks pretty good. It is positive, right? So positive earnings and greater than 5 of the last 10 years. We're going to put yes. Earnings growth, we're going to check it against ChatGPT to see what we have going on here. Diluted earnings per share again. Just copy and paste this into ChatGPT and then just copy from the Google Sheet that earnings growth equation, that metric we're looking at. Based off this one, it does the math for us, and this one does meet the requirement. It has a compound annual growth rate of 6%, which exceeds the 4.14 threshold. And another thing to notice here, if you have at least, right, earnings growth of greater than or equal to 50% over the past 10 years, but your CAGR doesn't meet the threshold, that still qualifies. But this one does, so we're going to put yes. Now PE ratio under 14. Now we will be able to use full ratio. You'll be able to see what that looks like. So we're going to look at MetLife here. I'm going to come over to full ratio, type in MetLife, pull it up. And this is just amazing because it just pulls all the data I need up instantly for free. Amazing, amazing tool. So let's look to see if we have a PE ratio less than 14. Now you have this PE ratio here, right? But what I really want to see is the average PE ratio over the last 10 years, right? So you just scroll down here, Met PE details, price to earnings details. And if we look here, the PE ratio history, the average is 20.15, right? 20.15, and it even tells you up here, it has an average 20.15 over the last 10 years, which is above the PE ratio of 14. So that one doesn't work. What I will show you, however, is one of these other stocks here in this sector, in the financial sector. Let's just take LNC, for example, and I'll show you what I saw on this one and why I put it into my Google Sheet as a potential investment, right? So this company, based off of what I found on Finbox, does meet the requirement as far as revenue, of course. Let me see if I can pull it up. Here we go. LNC, right? So this company came up on my screener for Finbox, right? It was one of the many companies in there. And basically when I took a look at this, if we go to the financials for this one, let's just go to overview, the 10-year, right? Let's take a look at the past 10 years on this particular company. Diluted earnings per share. As you can tell here, we had $4.51 10 years ago. And as of the last fiscal reporting, it was 18.41. So of course, well above earnings growth greater than or equal to 50% over the past 10 years. Now, as far as the PE ratio, is it under 14? So coming back to full ratio here, again, I want to see the average of the last 10 years. So we're going to scroll down here through some of these other metrics that are on here. Valuation, LNC, PE details. Click on that. And this is the average over the past 10 years, 9.23, well within range for our criteria of under 14. Now, price to book ratio, Is it less than 1.2? So we're going to go over here and just simply go to overview for the company, or stock analysis right here, excuse me. And basically what we're looking at now is to see if that price to book ratio is less than 1.2. If you just scroll down a little bit here, okay, price to book is right here under valuations, and it's 0.67. Again, well within our criteria. The next thing we're looking at is debt to equity, or excuse me, price to book, right? We want to see if the price to book is under 1.2. Wait, no, we just did that, 0.67. My apologies. Moving on. All right, so debt to equity is less than or equal to 2, and it is right here under liquidity on Full Ratio's website. Debt to equity is 0.72. So far, we have check, 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 check. A lot of checks in our favor. Now I want to see, does it have 5+ years of uninterrupted or stable dividends, right? So to find that, all I got to do is click dividends right here. And I can clearly see we have at least 5 years dating back to July 9th of 2020. And you can even dig deeper into this. You can actually go to dividend details right here, and you can see a full layout of their dividends and how long they've been paying it right here. It'll show you more. And you can actually, I mean, you'll just need to simply sign in with Google, but it'll show you the full history of it and even show you the yield on a trailing 12-month basis. So this stock does meet the dividend requirement. And so lastly, what you're going to be looking at here for this example with LNC is the gram number. And I also want to see the intrinsic value, right? To see whether or not this company actually meets it. So for the gram number, this is going to be a more conservative estimate of where the company should be trading at right now. And so basically you're going to take 16.8 and then you're going to multiply that by the earnings per share times the book value per share. And then the square root of that number is going to give you this 123.35, right? So the EPS and the book value, very simple to find. Just go back to overview stock analysis, right? You've got earnings per share, 7.29. And then all you got to do is look at book value per share, just a couple lines down, 48.08. And you have all the data you need to calculate the gram number, right? And so the square root of that, 123.35 again. Intrinsic value for this company is going to be earnings per share times 10.5 plus 2, and then G is going to be the growth part of this equation, right? Which is very important, and I'll get to that in a second. It's going to be multiplied by 4.4, and then all of that divided by 5.5. 4.4 is going to be what the historical corporate bond yield is at, right? 5.5 is going to be what it's currently at. We're talking AAA corporate bonds, right? What they're currently yielding. And so the purpose of those two numbers is to update for 2025 the intrinsic value equation, right? Now, basically what you're going to do, it's all very plug and play, which is nice. I've already taken the time to do all the math and update everything for 2025 for you. All you got to do is plug and play if you're using this. But for the growth, what you want to do is basically just go off of whatever that CAG number is, the compound annual interest, when you're using ChatGPT, right? And you're popping that in. Whatever that number is, a very conservative estimate, in my opinion, and I believe also in line with how Benjamin Graham would tackle it. Whatever that number is, just take a quarter of that, right? So let's say, for example, that, the compound annual growth rate for, LNC, right? Lincoln Financial, let's say that it was 8. I'm going to use 2 in that equation. And so basically all you do then would be 2 times 2 plus 10.5 times that earnings per share number times 4.4, and then divide whatever number that is by 5.5. That's your intrinsic value. Okay. And so you can already see a couple stocks that I found here that meet this criteria. Let me get rid of Met here, which doesn't meet the criteria. But basically, right out the gate, using math, right? We're not just using guesswork here. We're using principles that go back 80 years that have worked a long, long, long time. And we're able to find actual companies using our heads, using intelligence, and finding good value. That is the purpose of this, to have what Benjamin Graham calls a margin of safety. And so this last piece here is going to be whether or not it meets the criteria B through I here, row I. And basically, this is just saying, hey, look, it meets all these criteria that we just went over, okay? And then also it has to meet K, which is intrinsic value right here. The Graham number is a bit more of a conservative estimate. So it's great if it, also meets this criteria, but if it only meets intrinsic value criteria, I'm okay with that. And so, what do I mean by does it meet that criteria? What I mean is the stock currently trading for less than either one of these numbers, or ideally both of these numbers, the Graham number and the intrinsic value, right? And so if we look at Lincoln Financial, what it's trading at right now is $32.38. And according to the Graham number, the value on this is $123. According to intrinsic value, it's $156. That doesn't mean it's going to go there. But what I can tell you that means is this is a company that has a very, very large margin of safety, as we've talked about in other parts of this series. And so this, because of that, is a company that I am comfortable investing in. And one of the things that you'll realize going through this process, these are not going to be sexy companies, right? A lot of times the value is going to be in companies that aren't on the radar. That's why they're beaten up in their stock price. We're not talking like I was yesterday, right? We're not talking GameStop and AMC here. We're not talking meme stocks. We're talking very, very boring companies that just churn out profits every single year. And this is an example of it. I mean, earnings per share positive every year except for one, showing steady growth, paying out dividends. Total revenue for Lincoln Financial is $18.54 billion right now. I mean, this is it, folks. This is all you got to do. And yes, it is a little bit of work, but you know what? Nothing worth obtaining isn't going to come along with some work involved. But this is literally all I'm using for this full ratio Finbox. Yes, if you get a foreign company in there, you're going to have to do a workaround for full ratio, but by and large, you're going to be able to use this for any other company. And all the metrics you need are right in here. It's an amazing, amazing website, and saves me a lot of time as I'm looking for these various metrics. So the last thing I want to show here is my paper trading account that I opened up. So basically based off of these companies that I have found, right? I opened up a $100,000 paper trading account. It's fake money, but it's a way to test against real market data, what's going on. And so I just want to briefly show that and some of the holdings that I have in there. And this is the full list of it. I think I have 17 holdings. And basically the game plan here is to sit on these for a year. And then, check back in and see how things are looking to see how the plan is working. But based off of the criteria I just walked through with you, all of these companies meet that criteria, right? With the exception of two. So BND and VGIT. So these are treasury. This is a treasury ETF and this is a bond market ETF. And so basically the way I've structured this account is 60-40, meaning 60% in equities, 40% in either bonds or cash. And so basically I'm sitting on $10,000 of fake money as just dry powder on the side in case something else pops up on my radar. And then 30% are in bonds which would be, again, BND, VGIT. Position ratio for the entire portfolio is just above 8%. And then basically with the rest, 60% into equities. And I've divided that among the findings that I have so far, which is 15 companies, right? As you can see over here, the position ratio, I basically have 5% of my portfolio in each one of these companies, right? So well balanced, which is important when we're talking about not only having a margin of safety when looking at these companies and what their intrinsic value is relative to where they're trading at today, but also in portfolio structure, making sure that you're balanced. That way one position isn't hurting you or is outweighed by, the rest of the portfolio. So as you can see here, these are some of the companies, if you want to jot them down, that I've already found, but I wanted to make sure that you have the tools yourself to find and screen for, companies. For me, I will be checking in on this quarterly to screen for new companies, right? You could do it twice a year, every 6 months, right? You could do it annually. This isn't trading. I don't care if this account is up or down in any given week. I'll check on this quarterly, maybe twice a year, but this is investing, folks. That's the purpose of this series. This isn't about, trying to squeeze a couple dollars out of a day trade here. So some of the companies on here, as you can see, Tegna Inc., ticker symbol TGNA, Toll Brothers, just some of the more notable ones that have been performing well. And in case you're curious, I bought all these within the past month. So Oshkosh Truck is currently my top performer right now. Ticker symbol OSK. And Amcor Tech, Avnet, some of the companies in here, Pult Group, Unum, right? And this is just a few. You got Lennar, Century Community. So, I would venture to say a lot of people, probably when they think of the stock market, these aren't some of the names that pop into their head right out the gate. Like I said, these are the unsexy companies, but you know what? I don't really care, because at the end of the day, I'm investing for a profit, for a return, and I'm treating this as a part owner of these companies. I'm not treating this as if I'm just, here to make a quick buck as a trader. You have to view yourself, as Benjamin Graham says, as a part owner in these companies, and that's why we do such good due diligence when we're looking at the balance sheets, right? When we're looking at the income statement, when we're looking at the fundamentals. So that's a layout of, the various companies that I'm currently paper trading, sitting on, and, I'll be keeping track on this to see what it looks like. And, after a year, maybe I'll do an update, kind of see where we're at. But this is the process that I am taking to look for Benjamin Graham style investments. The Intelligent Investor is an incredible, incredible book. The knowledge in there still pertains to today as it did 80 years ago. As I've said before, I'll say it again. Benjamin Graham was a mentor to Warren Buffett, and Warren Buffett has said countless times that this book has been the foundation of his investing style for the previous 6+ decades, right? And we all know how well Warren Buffett's doing. So if it's good enough for Warren Buffett, it's good enough for me. So this wraps up the value investing series. Thanks for hanging around. I hope you got some value out of this. I will copy the Google Sheet layout into the description of this video. So feel free to utilize that. And as far as the next series that we will be putting out, it's going to be on trading psychology. I'm looking forward to providing that. Trading psychology is a very important topic that not a lot of people talk about, and it's something that affects everybody who's involved in the market. So that'll be the next series that we put out. That'll be coming soon. Leave a comment. Let me know what you would like covered. As always, I'll be back tomorrow for a market check-in for the week ahead. Remember, Memorial Day is Monday. We have a shortened trading week. But other than that, thanks for taking the time to hang out. And remember, plan the trade and trade the plan. Have a good night.